The Southern Arizona CCIM chapter is honored to have Eric Freeman from Beach Fleshman as our webinar presenter today. The CARES Act was not just PPP, which is the Payroll Protection Program. There are significant tax changes within the CARES Act. We will highlight a few that affect commercial real estate. We will leave time at the end for questions, and if you just put those in the question and answer box. So Eric, it's all yours right now.
Great. Well, I'm happy to be here. I know I spoke when we were still able to do meetings in person back in January, but since then we've had a lot of changes. So we had the CARES Act that was passed back in March, and a lot of it was not tax related, but in the CPA industry, we've been very involved in a lot of aspects of it. And they also just threw in some items that we had expected to be fixed in the past that for some reason, this is the moment they chose to go ahead and fix those technical corrections that we were waiting on. So there was some good news in there. So today, if you've seen me in the past, I like to just make a ton of slides and have a lot of material, and then I kind of pick and choose what I feel like going over in the moment. But we're for sure going to go over qualified improvement property, because that was one of the items that that we really wanted to see changed in the new tax law. And then I'm going to briefly go over some of the extensions that we have due to COVID-19 that are for opportunity zone investments and 1031 transactions. And then I'm going to go over just kind of a cautionary example for 1031 exchanges after we had the Tax Cuts and Jobs Act. So that was the big tax law change that was passed in 2017, and it didn't change 1031s overall, but they did make one small tweak to the language in that section that does have an effect when you're doing a cost segregation study. And then if we have time, we'll quickly go over some net operating loss relief that was in the CARES Act. So qualified improvement property. So just to set kind of a base level before we get into what the change was, I'm going to describe what bonus depreciation in Section 179 is. Essentially, for the most part, if you're required to take depreciation deductions over time rather than write off something immediately, then you can potentially qualify for what's called bonus depreciation, which ever since the new tax law was passed, so mainly in 2018 and 19, you can take 100% write-off for assets that qualify. And generally, assets that qualify are those that have a tax life of 20 years or less. So that's items like personal property, so any kind of movable equipment, office, chairs, desks, things like that. When you're talking about real property, carpeting, if you've done a cost seg, land improvements, so your parking lots and fencing, swimming pools, anything like that, generally has a tax life of less than 20 years and would qualify for bonus. And then our next special section where you can potentially get a write-off immediately is what we call Section 179, which is creatively named after the actual code section. So for the most part, this is just going to be your personal property. So a lot of times this is equipment and things like that. It does have its applications to commercial real estate, but it was limited in the past to the definitions. They had 3 definitions. There was qualified leasehold improvements, qualified retail improvements, and qualified restaurant improvements. And if you fell under one of those definitions, you could take a write-off as well, even though it wasn't personal property. So those were generally improvements to the interior of the building for tenants or for your business. And then they added another definition. They changed the definition completely, really. They took away those 3 different categories and they consolidated it into one and called it just qualified improvement property. So these were improvements. These are improvements that are in a commercial property, and you can't do things like expand the square footage. That wouldn't count. It's just the existing interior of the building, except for certain items that they specifically called out, like the roof, the HVAC system, fire and alarm systems, and security system. If you had those items, even though they may be part of the structure of the building or on the exterior, those would count as immediate write-offs as long as it was non-residential property. So kind of moving into what more specifically what qualified improvement property is, there were a lot of restrictions under the old law. The building had to be around for at least 3 years. You couldn't have a lease between related parties. So all of that got removed with the new tax law. The only issue was that, and this has been an issue since it was passed, is we were essentially expecting that qualified improvement property, so if you did improvements to the interior of the building, then it would qualify for this 15-year life. But when they actually wrote the code and issued the law, they left out that part. So it was by default 39-year, which meant that it didn't qualify for bonus depreciation like we had expected. So that was a big deal. So a lot of tax returns for 2018 and even for 2019, a lot of tax returns have already been filed, not taking bonus on improvement property that we thought was going to qualify originally. So I already went over some of the common class slides just to give an idea of what qualifies, but some examples of personal property: carpet, cabinets, appliances. Some of that's just if you do a cost segregation study. It depends on whether you've purchased it separately or you've purchased the building as a whole and then done a study. And then you have land improvements, which are essentially 15-year property outside of the building, and then your interior improvements, which are now 15-year. So some examples of qualified improvement property: most tenant improvements, which could include drywall, ceilings, interior doors, mechanical, electrical, and plumbing to the inside of the building would qualify. So just a quick example of why this is so important. Let's assume you've purchased a building and it's non-residential, so you've got a commercial building. Let's just say it's a retail building and you purchased it in 2016 with existing tenants and the cost was $5 million. So a couple of years later, you want to attract new tenants, and in order to incentivize them with new leases, you give a $700,000 tenant allowance for improvements to the interior of the building. Before the CARES Act was passed, those improvements would by default be 39 years, depreciate over 39 years, so you would not be able to take bonus depreciation on them. So if you actually, to get your depreciation amount, you essentially take that $700,000 cost, divide it by 39 years, and it's a little under $18,000 a year in deductions. Now with the CARES Act, they fixed that, and they specifically said that qualified improvement property now has this special 15-year class life. So now it's eligible for bonus. So in this case, you're able to write off the entire $700,000 cost in 2018 when you actually gave that tenant allowance and spent the dollars. So it's a big difference. You're essentially getting an extra $680,000 in deductions right off the bat in the first year. So the problem that a lot of people are identifying is, well, okay, we made this change retroactive in the CARES Act back to 2018 and 2019. So what about all the tax returns that were already filed? For individual tax returns, relatively easy. You can go ahead and amend to take advantage of the CARES Act changes. So if you had a commercial property that was reported on your individual tax return, you can make that change. However, if you had a partnership return, there were changes also with the new tax law back in 2017, where partnerships were subject to this new audit regime that was meant to make it easier for the IRS to audit the partnerships. And so if you fell under that audit regime, you actually were not allowed to amend your partnership return anymore. There are certain exceptions in there, but for the most part, you can't amend starting in 2018 and going forward. So given that a lot of returns were filed now with this longer class life and not being eligible for bonus, the IRS came out and said, hey, in light of the CARES Act, we're going to allow this one-time exception for you to amend your partnership return as long as you do it by the extended due date. And there's some instances for, so that's for 2018 and 2019. Now, if you extended your partnership return, but filed it before the CARES Act was passed, you can potentially do what's called a superseding tax return without amending, which essentially means that you could basically just e-file another tax return that overrides the previous one, as long as you do it before that extended due date. For 2018 tax returns, which you would not have that option, you can either amend the return and take into account the changes brought about by the CARES Act, or you can essentially calculate the benefits you would have gotten had you filed a 2018 return with those additional deductions, but then carry it over into 2019. So you're actually changing the tax year that you're getting those benefits. So you have an option. There's not a requirement that you have to do one over the other. So part of the consideration may be where you might need the additional deductions more, might determine which route you go. There's also, each one has its own challenges. And if you have multiple partners amending a return from 2018 and trying to flow those changes out to the partners may be an administrative burden. So you may choose to go ahead and just flush it through the next year because that's easier if the partners haven't already filed their tax returns already. So real quickly, switching gears into some extensions. So I'll go over the opportunity zone extensions and then we'll talk about 1031s. So we had a notice that came out in April, and this was the same notice for opportunity zones and 1031s. It also had a lot of other deadlines that were extended, but for the most part, all the deadlines for various returns, including individual returns, gift tax returns, and a lot of other returns that normally would have been due April 15th, all of those got extended to July 15th. And then the same thing happened for opportunity zones. So this applies to a investor or a taxpayer where their 180-day reinvestment period occurs between April 1st and July 15th. And April 1st is essentially kind of an arbitrary date of when this notice was actually drafted. So a lot of people were actually affected maybe if they had 180 days that fell just before April, but this doesn't really take that into account. And when you actually look at how the extension works, it doesn't really seem to be that helpful to the majority of people, at least in my experience. So just real quick before I go into an example, a reminder of what this 180-day period is. The 180-day period is the amount of time that you have, if you have a capital gain, to take that capital gain and put it into an opportunity zone fund and reap the benefits of deferring that gain and and potentially permanently excluding the gain from federal tax if you hold it for 10 years. So for pass-through entities, so most taxpayers are eligible for this. You can do it as an individual, you can do it as a partnership, even corporations can do this, trusts can do this. But most of the time, what I've seen is that we have capital gains coming from a partnership interest. And so if you have a partnership interest that's generating this capital gain, so say it's real estate, either the partnership can make the election and defer the gain, or if the partnership does not make the election and that gain flows out to the partners, then the partners are able to make an election to defer that gain. So over on the right side of the PowerPoint are the three options that a partner has for deferring the gain. You can either start your 180-day period on the date of the sale or exchange. So for example, let's say you sold a commercial real estate building that was held in a partnership and the date of the sale was July 1st. Then you would start your 180-day period on July 1st and count forward. And that's how long you would have to invest it in an opportunity zone. Or you can choose the last day of the partnership's taxable year. So if it was sold July 1st, 2019, and the partnership's tax year generally runs from January 1st to December 31st, then you would have from December 31st, 2019 and 180 days forward. And lastly, you could choose to begin your 180-day period on the due date of the tax return for the partnership tax year. So in this example, if it's a 2019 tax year, the partnership return would have been due March 15th. And the slide's a little wrong. It says March 31st, but it's March 15th. And the reason for that was a lot of times the partners wouldn't actually know the amount of the gain they had to invest until they received their K1 from that investment. So this allows you more time. So same date, if the partnership had sold that building on July 1st, you could elect not to begin your 180-day investment period until March 15th of the following year. So in our example, 2020. So a real quick example, this next slide. So I'll show what this actually looks like when you have a gain from a pass-through. So in this example, you've got a partnership and it sells an asset. So let's say it's a commercial building and it results in a capital gain on October 4th, 2019. I chose October 4th because that's the date where you begin to fall under this extension. Because if you count backwards from April 1st, 2020, 180 days, then you end up at October 4th, 2019. So the partnership sells the asset on the first date eligible for that extension. And the partnership does not elect to defer the gain, which in most cases is what I've seen so far. Generally, the partnership's not. It's the individual taxpayers that are making that election. And the partner, because the partnership did not elect to defer, the partner chooses to invest in an opportunity zone fund. So I'll skip to our summary slide. And what you'll end up seeing on the left side, I show if we do not have an extension for this investment, then our three options are listed. So we could have a 180-day period that's October 4th, 2019 to April 1st, 2020, or we could choose December 31st, 2019 to June 27th, 2020. And lastly, we could choose March 15th, 2020 to September 10th, 2020. So this is if we did not receive an extension. So you could essentially, if you look at all these dates, because you can't have a period that includes all of them, but you get to pick which one of these three periods. So essentially you can invest any time between October 4th, 2019 and September 10th, 2020. So a lot of flexibility. Now, if we look at our extended 180-day period, In our first option, we're starting at October 4th, and normally it would end on April 1st, but because our 180-day period fell in between April 1st and July 15th, that date's automatically extended to July 15th. So our first period is extended a little longer. Our second option, again, fell on June 27th originally. So now, because that's in between the 2 dates specified, that would also receive an extension of July 15th. And then our last option normally fell on September 10th. So because we fell outside of the April 1st to July 15th, 2020 dates, that last choice would not receive an extension. But if you look at our dates for all of these, you still can choose, because you have these three options, you still can invest anytime between October 4th through September 10th. So here, even though you began your sale on the first date available to receive an extension, you actually didn't change any of your dates because of that. So that's why I don't really see much of, I don't see this being very applicable. I mean, unless you're an individual and you're selling stock or something like that, then you may receive an extension. But again, even in that case, you know, what if your 180-day period ended on July 10th? Then you're only getting a 5-day extension to July 15th. So, so I think for the most part, this isn't going to affect a lot of people, just because of the flexibility that you already have with a lot of these gains, and because of how they made the extension work. So moving on to the 1031 extensions. And this, like I said before, was all part of the same notice that was issued. So it works exactly the same, except you have two deadlines that you're paying attention to in a 1031 exchange. You have your 45-day and your 180-day deadlines. The 45-day deadline, just as a reminder, is the amount of time that you have to identify your replacement property in a 1031 exchange. And your 180-day timeline is the amount of time you have to actually close on any of the identified properties. So again, if either of those deadlines fall between April 1st and July 15th, then you get an extension to July 15th. So I'll just do an example. I'll do one showing a 45-day extension and then one showing a 180-day extension. So in this example, you've got a exchange that begins on April 1st. Your 45-day deadline would fall on May 16th. It's 45 days after April 1st. So because you fall in between April 1st and July 15th, you'd receive an extension on your time to identify a property. So this would give you from April 1st to July 15th to identify the property. And then your 180-day deadline falls in September on the 28th. So because that falls outside, you actually don't receive an extension on your time to close on the property. So in this example, you only receive an extension to identify the property, but not to close on it. So here we have the opposite. If you have an exchange that started a little earlier in 2019, so it started November 15th, 2019, then your 45-day identification period falls on December 30th, 2019. So you're not going to receive an extension to identify, but your 180-day deadline to close on the property ends on May 13th. So this gives you an extra couple months, almost a little more, to close, because you have until July 15th. Now the issue with this type of scenario is that by the time you had to identify the property on December 30th, even though you get an extension to close, it's really not helping you that much because you've already had to identify. At that point, you know, you could have changed your mind. The value of the property may be significantly different, especially if It's one that was subject to closures. Maybe it was a lot of retail or restaurants that were subject to closure, and now all of a sudden, maybe you have more tenants in default on their leases or closing or things like that, but you can't change the property you've identified. So you either have to go forward with closing. So I'm not sure how much the additional time really does for you, because you're still going to end up with the same property. Maybe it gives you a little more time to decide whether you still want to move forward with it, but you've already locked in your identification. There's a few more examples we'll just kind of skip through. But the point of most of them is that the extension, again, is going to be unhelpful a lot of the time. So there's been a lot of chatter about trying to get this modified for taxpayers to make it a little more useful. So one of the changes that we're hoping for is that instead of using April 1st, which was kind of an arbitrary date, is to use March 13th, which was the actual date that we received the emergency declaration. And then instead of only getting an extension to July 15th, actually extend both deadlines by 120 days if either of them falls between March 13th and July 15th. So that'd be a little more useful. And then lastly, this would fix the issue we just went over in the last example, would be the ability to go back and change your identified property if your date had already passed before we received that emergency declaration. So that would give you the ability to decide on a new property and also give you potentially an extra 120 days to identify and close on the property. I'm not sure that any of those changes will pass at this point. But those are some things that people have been trying to get. So now I'm going to move into an example of cost segregation studies and why they were impacted after we had the Tax Cuts and Jobs Act in 2017. So like I said at the beginning of this presentation, there wasn't a huge change in terms of 1031 exchanges when it came to real property. But in the past, you were actually able to do a 1031 with personal property. So a lot of times this meant company vehicles. You could, anytime you did like a trade-in or something like that, you could actually do a 1031 exchange and not recognize gain on that personal property. And this also played into when you had real property and you did a cost segregation study, because part of that cost segregation study is that you are identifying separate parts of that property that may actually be personal property. And so if you've done that, those items may not be eligible for an exchange if you've started that exchange after the new tax law was passed. So I'm sure I've already talked about cost segregation studies in the past, but just as a quick reminder, these are very popular on commercial and residential properties. Essentially any property, now that we have bonus depreciation, any property with a cost of $600,000 or more, it generally makes sense to do this. And it's where an engineer goes in and they break out the different types of the property into different class lives. So for the most part, you can break it into 5-year property, 15-year property, and then 27.5 and 39. So by default, your residential properties, so apartment complexes, are 27.5 years. So whatever your purchase price is, take out the land and then divide it by 27.5, and that's your annual deduction for that purchase. And then the same for a commercial property, except you're dividing by 39 years. But when you do a cost segregation study, you can break it into these shorter class lives. And so instead of taking it over almost 30 years or 40 years, you're actually taking it over maybe 5, in some cases 7 years, and then 15 years. And it's not just that you get a shorter recovery life. What ends up happening is, because you've now fallen into these different recovery periods, now they become eligible for things like bonus and Section 179, because they have these shorter class lives. So it's a double benefit where you're accelerating a lot of depreciation, getting those deductions now, and it's a time value of money type of play for the most part. So there's a lot of good times to do these studies. Anytime you're doing construction of a new building, if you purchase an existing building, if you do a big remodel renovation, those oftentimes you'll get more items in those shorter recovery lives, because you're putting in a lot of items that may not be structural, that would otherwise stay at the 27.5 and 39 year periods. And then even before you sell a property can be a good time. Even though you have to recapture the depreciation deductions, in certain cases you can actually remove some of that recapture, because you're essentially not giving any value in the sale to some of that 5-year property, saying essentially that it wasn't really what the buyer was purchasing, and so you don't recapture depreciation there. So now I'm going to do a quick example to illustrate what you have to be aware of, since you cannot exchange personal property though. So here I'm doing the examples with an apartment complex, but I mean, you can apply this. This is the same, the numbers will be very similar if you have a commercial property. Just the common breakouts between the 5 and 15 year may be slightly different, but the concept's going to be similar. So in this instance, you've purchased a residential apartment complex for $10 million on January 1st, 2018, and you decide, based on the appraisal, that 20% of it is attributed to the land, which is not depreciable. So you'll be able to depreciate $8 million of the cost. And you decide you want to accelerate some of the deductions on that building cost, so you do a cost segregation. So the first year, if you did not do a study, you would have your standard depreciation by default over 27.5 years. So you'd take your $8 million that is allocated to your building, and you divide it by 27.5 years, and that would be your depreciation deductions, would be a little under $300,000 per year in this example. But because you've done a cost segregation study, the engineer's gone in and identified and indicated that 25% of your property is 5-year property, 5-year property. So that would be things like your carpeting, certain electrical outlets, appliances, some cabinetry, items like that would be allocated to your personal property, and that comes out to $2 million, which is 25% of your $8 million total building costs. And then 15-year property represents 5% of your total building cost, or $400,000. And then lastly, the amount that couldn't be identified as a shorter recovery life is 70%. So this is a lot of your structural foundations, walls, roof, those type of materials would be your building. So that's 5.6. So if you do the math on all of this, now because we have this bonus depreciation, so let's just say this was a commercial property, that 15-year category would most likely be qualified improvement property, and so that would be eligible for bonus now. Before the CARES Act, it would not have been, but we were fortunate in that change. And then your 5-year personal property is also eligible for bonus. So you're essentially writing off 2.4 million right off the bat. And then in addition to that, you get your regular 27.5 year recovery period on 5.6. So if you actually add that up, it's about 2.6 million in deductions, which is a big increase. You were getting 300,000 before this study. So definitely worthwhile to do it in this case. So now let's say you've held on to it for a couple years, so it's 2020, and let's say that you have a sales price of 15 million. Maybe you've done various improvements, maybe you've leased it up, whatever it is, your sales price is higher than what you paid for it. When you sell a property, in order to get the correct depreciation recapture, you're required to assign different property a sales price. So that means if you have your land, which is non-depreciable, you have your regular building structure that's over 27.5 or 39 years, and then you have the various 5 and 15-year property that you're required to assign a specific sales price to each of those, because you need to determine how much will be recapture and depreciation for each one. So different property has a different recapture rate. So for example, most of your 5-year property, which is the personal property, is going to have a recapture rate that's at your ordinary tax rate. So that could be anywhere up to 37% now. And then your 15-year and your 27 or 39-year property is going to have a recapture rate of up to 25% potentially. So ideally you want to push more. If you're going to have recapture, you want more in those longer recovery lives, because you're paying a lower tax rate on those. So real quick, what this actually looks like if you break it out into the different property lives. So here over on the far left, I have the original cost broken out. So this is the same dollar amounts that we saw on the previous screen, where you've got 2 million assigned to the 5-year, 400,000 assigned to your 15-year, and then 5.6 assigned to your 27.5-year. And then you've got your leftover for land. And then the next column is our depreciation amounts that we've taken over 2 years. So like I said, on our 5 and our 15-year, we were able to immediately write that off with bonus depreciation. And then our 27.5-year, if you did the math and you took our 5.6 and divided it by 27.5, and then multiplied that number by 2, it'd be somewhere around 400,000. So our total depreciation that we've taken on this building is 2.8. So then going over further, what that means is our net cost, so is just our original cost less whatever depreciation we've taken, is 7.2 million. And then we look at our sales price of 15, and we have to assign the actual dollar amount to each of these property types. So there's a lot of different ways that you could go about doing this. The way I did it in this example is I essentially took, for our 5-year property, I just said, okay, normally we'd have a 5-year recovery life. So if I just took that regular recovery life and took out 1 or 2 years that have passed by, then we'd assign the same percentage of our 15 million. So that came out to 1.6. So I'm saying, even though we paid 2 million for it a couple of years ago, these assets haven't actually appreciated, which makes sense because a lot of times it's items that have a lot of wear and tear that lose value as soon as they're purchased. So your appliances are going to be less valuable. Carpeting is not going to be worth much because you have to replace that on a regular basis. So we're only assigning 1.6, but our 15, 27.5 and land, those items generally are the ones that are going to have your appreciation. Now it depends on, for the 15-year, if this is a commercial property, maybe those are qualified improvement property, maybe those were tenant improvements. And if those were tenant improvements and maybe the tenant is no longer there, or maybe there's a lease coming up and you know that a new tenant's not going to be able to use a lot of those improvements, you may be able to justify that that there's not actually an increase in value in those because they would have to be torn out and replaced with a new tenant. But in this example, because we've got an apartment complex, our 15-year property is going to be things more like our land improvements, so parking lots and sidewalks and fencing and things like that, that generally have a longer useful life, despite whatever's assigned to them by the IRS. So here I just kind of prorated between our 15, 27.5 and land and said, whatever is left of our 15 after we've assigned our 5-year, that'll go based on our original cost to these other property types. So once we do that, we have our gain all the way on the right side. Now we've assigned our property. So this tells us how much we have to recapture. So if we're doing a 1031 though, then we don't have to, then we're not recognizing gain, and therefore we don't have to recapture. However, so in the past with this 5-year property, which was personal, you may have been able to exchange out of it because personal property was eligible for 1031s. But now that the Tax Cuts and Jobs Act removed personal depreciation from being eligible for exchange, you can actually only exchange the 15-year, 27.5 and land for a new building. So the 1.6, if you were to sell it with these assigned prices, you would end up recognizing 1.6 million of gain on that 1031 exchange that you may not have had to in the past. So this is just something to be aware of if you've either done a cost segregation study in the past or you plan to do one with a property that you may do a 1031 exchange with. You may consider on some of this, you know, one of the ways to try and lower that gain amount may be to look at the time period that you've held the property. So, I mean, the longer you hold the property, the easier it's going to be to justify that 5-year property doesn't actually have much value. So if you had actually, instead of holding it for 2 years, maybe hold it for 5, and you look at what type of property's in there. So if you have a lot of carpeting and most of it needs to get replaced anyway, then you can take away some of that value and lower that gain and have more of your gain in the other property that you can actually exchange. You know, there are some considerations if you're going to do a reverse, which means instead of doing a cost segregation study on the property that you are selling, but instead you also want to do a cost seg on the purchase property, then there's some treatment that you just want to be aware of. And I'm not going to get into the details of it just because we don't have much time, but just something to be aware of, to think about, and ask whoever you're working with what those considerations are. And then the last section that I'll go over is relief for net operating losses. So this was part of the CARES Act also. We had, you know, some more favorable treatment for NOLs before 2017, where you could actually carry back, if you had a loss from a business, say you had a loss in 2019, then you could actually carry it back 5 years and offset income from those previous years and get refunds. And then you were also able to, if you didn't have any income in those previous years, you could carry it forward and offset income in future years. And then when the Tax Cuts and Jobs Act was passed, they took that away, and you couldn't carry back a loss anymore. You could only carry it forward. So that was a pretty big change. And then they also on that carry forward. In the past, you were able to completely offset your taxable income, and then they limited it so that you could only offset up to 80% of your taxable income in a future year. So, it affected, a lot of taxpayers that, especially in the real estate industry, where you're getting a lot of deductions from things like cost segregation studies in one year, and then the next year you'd have income. That now became a consideration, knowing that, okay, we're not going to be able to offset all our income in the future year. So maybe depending on what those your tax landscape looks like specifically, we may not choose to do bonus because we'd want to smooth out those gains or those deductions. So it just planning became a lot more complicated in a lot of cases. But in light of everything that was going on with COVID-19 and the CARES Act, they essentially brought back some of that old law. So now you're eligible if you had a loss in 2018 and 2019 and 2020. So 2018 and 2020, you could actually carry that back again 5 years, which you weren't able to, as far as we knew, back in February of this year. You can still carry it forward, but now instead of being limited to 80%, if you carry one through 2020, you won't be limited at all. But then it'll go back down to that limitation after 2021. So I think I made it through and covered everything. So I don't know if we have any questions to go over, but I'd be happy to answer them.
Yeah, this is Gary. There's 3 ways that you could do questions. You could email them, which I think you got an email blast on that. You can also put it in the question and answer, or you can put it in the chat and I can unmute you and you could ask your question. But Eric, let me ask you a question first. On the 1.6 million, the one that you just went over with the 5-year personal property gain, is it possible that we could defer that by putting that in an opportunity zone?
Yeah, that is one option that you could do. Well, it depends how much is recaptured, I guess, because if it's subject to the ordinary rates, which most personal property is, then that's not eligible for exchange. But if it's anything above that depreciation recapture, then it would be an eligible capital gain. So you kind of have to look at what your specific recapture in each example is, and see how much is actually eligible.
Okay, Tiffany, do you have any questions that were emailed to you?
Nope, I don't have any questions yet.
Okay, I don't see any in the chat. Go ahead, Tiffany.
No, I was just going to say, but, we'll send out the video and Eric's contact information. And so I'm sure if questions come up, they can ask him. Oh, wait, it looks like we might have one. Hang on. Oh, James Robertson. Great job, gentlemen.
I like it. Easy question.
Thank you, Jim. Oh, I have one in the chat. Maybe they want to ask the question. Oh, no, that was just Jim. Eric, let me ask you one more question. Is there any reason, it's a little confusing on the opportunity zone, they give you 180 days, they give you till 180 days after after December 31st, then they give you 180 days after your due date. Was there any logic with that?
So it started with when they first came out with the regulations, it just began on the date of the sale of whatever asset it was that was generating that capital gain. But then because they were allowing individuals that were invested in partnerships to also make that election, first they allowed an optional period that started with the end of the tax year for the partnership, because they figured, well, if the partnership sold something in the middle of the year, that doesn't mean that the partner would actually know that date of sale. Or they may not, even if they knew that something was sold and when it was sold, they wouldn't know the actual gain that was generated from that asset. So that gave additional time for the partners to figure out how much they could defer. And then lastly, and this change came about in December of last year, so very recent. They figured, okay, well, even if we get to the end of the tax year, a lot of times because an individual isn't receiving their K-1 from the partnership until March, they may still not know the amount of the gain. So they allowed you to choose that last optional date under that reasoning, that you wouldn't actually know your gain potentially if you're invested in a partnership.
Okay, well, thank you very much for that. And on behalf of CCIM, I just want to tell you what a great presentation you did, and we really appreciate it.
Yeah, thank you. I was happy to do it.